We are looking towards this market momentum because of two very positive indications that have happened. One, it looks as if China is all in when it comes to providing stimulus, and as well, you have the Federal Reserve and other global central banks that are also quite accommodative. So we think that the overall markets across the globe can continue to see a 3 to 5% increase over the next 3 to 4 months.
So that is really, it's amazing how I move. I was just there, and now there's two of me. It's like the movie The Prestige. There's actually, I have a twin, an evil twin. Here's the thing. You expect 3 to 5% growth. Ironically, as we just noted, of the 26 times that's happened, the gain over the next year has been about 6%. So the technicals seem to be matching up with maybe some of your value analysis.
Right. And what's going on here is you have the Federal Reserve that's quite accommodative. We're going to continue to see multiple expansion, even in light of perhaps an earnings recession. And keep in mind that this is just about timing here. We think, though, in the short run, the markets can move quite boldly to that 5% run.
How can we have multiple expansion when earnings are starting to slow down? Earnings growth.
Well, you've seen that before over the course of the last 10 years where the Federal Reserve was quite accommodative and you got very little revenue growth and earnings growth overall, but you did have that multiple get up and go where the markets did quite well. We continue to think that will happen. We are not, though, terribly concerned that the global growth environment will fall into a scenario where you'll see global growth decelerate to 2%. As long as it stays around 3% global growth, then we think that can sustain this type of positive momentum.
We have many guests on this fine network who say you should be more overweight international stocks than the U.S. You fundamentally disagree with that view.
Yeah, I believe that, and perhaps our whole team believes it, that we think that there will be dollar strength over the course of the next 6 to 12 months, that the U.S. economy is perhaps the best region of the globe with the most stability even though GDP is going to be decelerating down to 2.25%. So we'd be overweight dollar-denominated assets. We look towards sectors like industrials and also look towards the long end of the yield curve. We do continue to believe that the 10-year bond can continue to rally, where interest rates will continue to go lower.
Dollar index has posted 4 up quarters for the first time in 10 years. So the strong dollar trade has been on. But we hear all the time, Chad, that a strong dollar can be a negative for U.S. multinationals.
It could be a negative when you look at the currency side of it, but analysts actually don't do that. We think that overall that the strong dollar for a U.S.-based investor, could be a positive because you're not getting that headwind when it comes to the dollar strengthening. So we want to stay in the United States. We think you can continue to see a 3 to 5% accretion in the dollar over the course of the next 6 to 12 months.
And healthcare looks good to you.
We like healthcare. We would be overweight some of the steady Eddie healthcare, pharmaceuticals, as well as the HMOs.